I realized that early on, commercial real estate was one, more aligned with the wealth building goals that I had and the timeline that I wanted to achieve those goals in. And I also realized that the ROI on my time and the skill set that I had in commercial real estate, which was finding deals, finding a way to stabilize and maximize the income, fix up the property, and ultimately, expand and force value into these assets, was something that my team and I were good at.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Welcome, Decoding Cash Flow listeners. We have a very special guest today, Matt Aitchison. He's a hotelier, investment syndicator, a sought-out speaker in the real estate industry. He began his career as a realtor, but soon transitioned over to real estate investment full-time. And he has flipped and wholesaled over 100 houses and scaled his passive income portfolio to include retail strip centers, medical plaza, single-family rentals, a laundromat, apartment buildings, and hotels. Wow, that's a long list, Matt. And now he's focused solely on raising capital for his own syndications and developments across various hospitality assets and brands. Matt is also a host of podcast Millionaire Mindcast.
Thanks
To
for
have
having
you
me on,
on the
Ted.
show. Yeah, thank you. So, Matt, as we spoke before this call, right? You're mainly focused into hotels, commercial real estates, and I think in the commercial real estate, malls, as I see it's a malls, medical, office, laundromats. So it's a huge array of different kind of commercial real estates you are focusing on. You started as a realtor, so let's start from the beginning. If you can tell our viewers about how did you get started into real estate? First of all, why you joined realtor and how you transitioned over as a full-time real estate investor?
Yeah, as I was graduating college, I kind of created a career hit list. I had this expensive piece of paper in my hand and I still didn't know what I wanted to do with it. And as I moved back to Sacramento, I went to UC Santa Barbara. I moved back to Sacramento and I was really starting to kind of create this career hit list of all of the, ideal things that I wanted in my first or my next job, my career. And as I was interviewing at a bunch of different places, just trying to find something at the time, 21 years old, living at home, in debt, not making any money, was just trying to find, some income. And as I was interviewing at most of these places, it was like $30,000, $35,000, $40,000 starting. And I had much bigger goals and aspirations, right out of the gate. And I knew that working for somebody else just wasn't going to get me to where I wanted to go. I was pretty clear on that early on. And as I went through that interview process, it affirmed that. And when I went back and looked at my career hit list, it was, be my own boss, have the freedom and flexibility to create my own schedule, no, cap on what I could make in terms of my earning potential. I wanted to make a difference, in people's lives and have it be in a space that was, productive and positive. But the last one that, kind of was the real linchpin and the asterisk next to that career hit list was I wanted to be in an industry and in an opportunity that allowed me to generate wealth. And when I was 12, 13, 14, both my parents, who divorced early on, were, kind of corporate career climbers. And both of them early on had kind of told me, to bet on myself. And my mom started taking me to real estate investing and personal development seminars when I was in my early teens and really throughout high school. And so I kind of had the seed planted around personal development early on. I was going to real estate conferences and seeing people stand up on stage, flashing six-figure checks. And when you're young, you get enamored and excited with that kind of stuff. But that went pretty dormant. I went to college, obviously graduated, moved back. And as I was scouring job postings online, I came across a Craigslist ad that said real estate investor seeks real estate mentee. And I responded to that ad. This was back in 2010, post-financial crisis, where in California, there was foreclosures everywhere.
Yeah.
And I ended up interning for a guy for a year, working for him for free. He was a house flipper. And so I got exposed to kind of the world of real estate investing, how he was buying these houses. I was the one essentially managing all the projects and the dispositions of these assets. And so I got to see the project, and these opportunities from start to finish. And more importantly, I got to see kind of behind the curtain that he was making $50,000, $60,000, $70,000 a pop, and I was working for free, making nothing. And while I got a great price of education, I learned the process, I understood kind of, the high level structuring of these types of opportunities, I decided to start looking for my own very first flip. And long story short, that led me to, I'm sure many people have heard of different stories with hoarders and cat ladies and all of that kind of stuff. And that's what my first house was. It was a cat lady house, 100 stray cats in her home. When we removed all the trash from it, I found 2 dead raccoons in the house as well, which is pretty insane. But I ended up at 21 making $106,000 net on that first flip. And that was using none of my own money. And it really was kind of that light bulb moment that this was my path for, unlocking financial freedom, generating income. And so that was what got me into the real estate industry. 1, first working for free. 2, going out and finding my first opportunity that I raised private money on and funded 100% using other individuals' capital. And that kind of was the beginning stepping stone into my real estate career, which led to me kind of building up my own real estate team. I was doing the investments as well. I also partnered with a contract to kind of build out a construction company. So I was kind of vertically integrated, looking at the different, really taking a page out of Warren Buffett's, snowball book, which was the core tree trunk of, business was my real estate investing. I also had other ancillary businesses that were synergistic with that focus of my business. And then ultimately that led to me looking at, over the course of the next 3 or 4 years, where I really wanted to spend my time. And I realized as a realtor, I was spending way more time trying to build a real estate team for a fraction of the income, whereas an investor, I was 1, more passionate about it. 2, it was way more profitable. And 3, I was spending a fraction of my time on it. And so I doubled down on that and ultimately, flipped a couple hundred houses over the course of the next few years. And I realized, well, that was great. I was only as good as my last flip. It was a high volume, high stress kind of business model, and also high risk business model. And so I started thinking about, when I was looking at other mentors and friends who had really unlocked kind of the lifestyle and the wealth that I was looking to achieve, most of them were finding ways of holding assets. And so while I had good vertical income and I was kind of trading time for money, I wasn't using any of that money to go and build out passive income or mailbox money opportunities. And so as I was flipping more, I started finding ways of holding, flip 3, hold 1, flip 4, hold 1. And so I started building up my single family portfolio. And then I quickly learned that single family, I'm going to need a lot of these houses to get to the level of passive income that I'm looking to kind of unlock on a monthly basis. And that's when I ultimately started converting my energy and attention more towards commercial real estate, which led me into buying my first strip center and then my next medical plaza. And then ultimately that led me into buying my first hotel, second, third, and so on, which I'm sure we can unpack a little bit more. But I realized that early on, commercial real estate was, 1, more aligned with the wealth building goals that I had and the timeline that I wanted to achieve those goals in. And I also realized that the ROI on my time and the skill set that I had in commercial real estate, which was finding deals, finding a way to stabilize and maximize the income, fix up the property, and ultimately, expand and force value into these assets, was something that my team and I were good at. And that's where I kind of doubled down on that focus and ultimately ended up kind of parlaying that business model into hospitality assets, which is where I spend most of my time today.
Awesome, man. That story of yours aligns to my experience as well. I started back investing in real estate in about 2012. All right. I didn't want to work for anyone. I had a high profile job in with Wall Street banks,
Yeah.
as a business analyst. But as soon as I got my green card, like I'm a migrant from India. I
Okay.
came here in 2000 actually, to do my master's in computer science. So I worked with investment banks for a while. As soon as I got my permanent residency in US, I could, I started my real estate career. And similar to you, I worked for free for one of my mentor. He was a construction guy. I worked for him for a while, learned how everything goes, how the permits, works, and getting in touch with all different subcontractors. And then I started my, fix and flip. Actually, I also started buying houses from sheriff sale, all the foreclosure properties I started
Okay.
buying initially. And where it is a multifamily, like anything about 2, 3, 4, anything such. And if the cash flow makes sense, I keep it for myself. The others, I just dispose it.
Yep.
And recently we moved into, and not recently, but I would say in 2016, we started focusing on building luxury single family houses,
Okay.
like the price point above like 2.5, 3, anything above that. And meanwhile, in 2018, we started focusing on multifamily syndication. So just, diversifying along the way. But our main bread and butter is construction, development of luxury single family homes, as well as development of small multifamily properties, around 25 units or less.
Okay.
Yeah, I would be much interested in knowing about commercial real estate, so maybe I'll just pick up your brain on how maybe I can also pivot in more into commercial space, except for multifamily, other than
Right.
multifamily. Yeah.
Yeah, I mean, there's so many different asset classes in commercial real estate. I mean,
Yeah.
I've invested in a lot of different ones, whether it was me actively as the sponsor or more as an LP and a limited partner in a syndication.
Mhm.
I think it's important for people to kind of identify what is the asset class you really want to focus on, because there's nuances to every asset class.
Yeah,
And there are risks that come along with every asset class.
absolutely.
Obviously, hotels, that was one that I just kind of fell into on accident.
Uh-huh.
And I had one of my social media followers bring me, an off-market opportunity, which ended up being my first hotel that I bought in Lake Tahoe. And while I had a great skill set of, taking, beat down properties and physically renovating them to a nice quality standard and condition, one of the things
Yeah,
that, I learned the hard way was hotel assets, which are, hospitality assets,
mhm.
which are very different, because there's different asset classes of hospitality assets in terms of short-term rentals on maybe just a single family Airbnb, right?
Yeah,
There's the small mom and pop hotels. There's the larger flagged corporate, managed hotels. RV parks can be run as resort style hospitality assets. There's a lot of
yeah,
different ways that you can look at hospitality assets. But the one thing that I learned the hard way on hospitality assets is they are a 24/7, 365-day operating asset. So
that's right.
really, you're not just buying an asset that is, going to be more of the mailbox money and the passive income. You're buying an operating business that happens to be operated out of a physical real estate asset. And that was something that, was a very large learning curve, in the sense of buying something and putting a tenant in there and locking a lease down and maintaining, a quality relationship with the tenant, maintaining the asset. It's a lot easier to build systems and create a little bit more leverage in certain models of those types of real estate assets. Whereas,
Mhm.
Hospitality assets, it was 24/7, 365, living, breathing organism that had people, customers coming in and leaving all day, every day. And so that was something that really became what was a, silver lining, a blessing, and a great
Yeah,
challenge that forced us to become really good operators of assets. Because, just like the value of commercial real estate is based on net operating income, if you don't find ways of increasing the net operating income and you start moving in the wrong direction, it can get
yeah,
really risky to, lose your shirt on certain assets. So fortunately, we were able to, streamline our team, rebrand a lot of our assets, renovate those assets, relaunch the hotels, stabilize the financials, and either recap those deals or trade out of them, in 1031s. So that's kind of been my model, is looking for a lot of people on commercial real estate look for more maybe cash flowing passive income real estate assets, which I do have some of those in my portfolio. I just call those my coupon clippers. They're a lot, those are the real mailbox money, like my medical plazas, like the strip centers. Those can become a lot more passive, and kind of my active time and energy and my staff's time and energy. We get the greatest ROI on our skill set of taking dilapidated properties, creating good branding, creating a good physical product and programming in those spaces, and then obviously creating a good team culture, operating standards and execution, which allows us to increase the income on those assets, therefore the value of those assets, and it can be very lucrative. So that was something that, I learned the hard way in the hospitality world, but I also learned that I was very passionate about it. And if you would have told me, at the beginning of my investing journey that I would own and operate hotels, I would have told you you're crazy. But that's a beautiful thing about real estate, right? Is you never know where your entrepreneurial journey is going to take you. And if you keep, refining your vision, refining your goals, and you put the right team and the right people and the right plan in place, and you kind of just execute on a daily basis, you look up in 10 or 15 years and you get pretty impressed with some of the ground that you've covered, which I would have never thought was possible for myself when I first, began this journey.
Yeah, absolutely. The thing is, with the hotel industry, as you know, from my last name, Patel.
Yep. I've met a lot of Patels in the hotel industry.
I have a lot of relatives also in the hotel industry, and especially one of my cousin, he builds hotel.
Okay.
Ground up construction for big hotels.
Yep.
And I got a chance to work with him on one of the acquisition, because he was doing an acquisition for one of the hotels he's building in Dallas. And acquisition side means material acquisitions. Me and my cousin, we went overseas to buy all the material for the hotel, starting from tiles, all the amenities, wallpapers, each and everything except stud
so you guys
and
sourced
drywall.
everything.
Yeah, except stud and drywall.
Okay.
Lighting fixtures, everything, furnitures, everything from outside. So that created an interest for me. Maybe, if I can get more leg room, or maybe, get into more of these hotel construction kind of business, might be a good option.
Yeah, I think depending on, because there's really kind of two different types of there's a lot of different types of hotels, but really I kind of just bucket them into flagged hotels that, are your standard corporate owned hotels that have good operating models, but there's restrictions obviously on what you can and can't do. But they're proven models. And oftentimes, those management models really are great for somebody that's looking to be a little bit more passive and have a management company in place, have a proven flag in place. And usually you can clip anywhere from 15 to 20% on those, with not necessarily hands off, but not as active management. Whereas, my model is more boutique hotels, where we are completely operating the assets with our own programming, our own teams, our own brand standards, which gives you, there's pros and cons to that as well, right? Which obviously, if you don't have those proven systems, you don't have that brand recognition, you don't have some of those experiences in the hospitality space that you can lean on, maybe a corporate management company like a flag to do for you. There's some risks associated with that, but there's a lot of freedom and flexibility that comes with that to create really cool, eclectic experiences that I think travelers and people are really looking for nowadays. So we see a lot of upside and runway in the boutique hospitality space. Even if it's not a big, resort style hotel or 100-key hotel, there's some really cool boutique, eclectic, unique, one-of-a-kind experience brands out there that are 10, 15, 20 keys. But again, I think what it comes down to is really being able to execute on your operational plan, because that's what either makes people get those big 5, 10x returns, or it could also lead to, some not so pretty days on your P&L and balance sheet if you're not operating properly. But hotels are a really fun space. And I love, obviously, the fact that they have all of the benefits of traditional real estate, income, tax advantages. The other side of it is, these hospitality assets are also a lifestyle play for me and my family. One of the things that I envisioned for myself and for my family was that we'd be able to travel, create memories and experiences together. And we've been able to do that in many of my hotels. I've got so many awesome memories with my two daughters and my wife going to my hotels. I get to expose them to business and entrepreneurship. They can't go with me to my strip center around the corner and go tour in the liquor store or go in the dry cleaners and have a blast, right? But they can go with me up to Lake Tahoe and hang out at the lake and go get pizza and do s'mores around the campfires and stay at the hotel. And so that's been something that I've really enjoyed about hospitality assets that you can't always get with other, real estate plays.
That's absolutely right. What are your main criteria when you look for a new hotel, right? Like number of rooms, area, what are the different criteria, including like the occupancy rate, etc.?
Yeah, I mean, for me, I'm not looking for stabilized assets. So most of my stuff, I'm looking for distressed opportunities, which generally are going to have lower occupancy, lower net operating income. And we're looking at, the areas, knowing what we know, that have the ability to, of course, right, drive additional revenue to the top line, that have the ability to lower OpEx and, drop more profit to the NOI and bottom line. But ideally, in terms of markets, I'm a leisure-driven market investor. So I like markets that have sun, sand, snow, fun outdoor activities, things that year-round have people coming to them, whether it's winter or summer. I don't invest in business-driven assets. A lot of hotels, were crushed during the pandemic because 80% of their revenue were driven off of business travel. So mine is more leisure market assets. And then, of course, obviously, we're looking at, opportunities based on how those assets are being operated. We're tech friendly and tech heavy. So we like to integrate a lot of prop tech, which wasn't around, a long time ago, for mom and pop operators to integrate some of that stuff in and really create efficiencies, one, for their customer experience, two, for their operational side of the business. So we integrate a lot of technology. So we look for efficiencies in that capacity in certain assets that don't have those in play. Obviously, looking at their online brand and what their presence is in terms of reviews, as well as, are they getting direct bookings? Are they relying heavily on the outside, online travel agencies to, drive that traffic? Because if it's all reliant on travel agencies, and we know that through good SEO, good website, good marketing, we can drive more direct bookings and generate more revenue that way. There's a lot of different strategies that we look at, but ideally, leisure markets, we definitely want to know that there's upside in the net operating income, because if I can get a distressed asset, that I can buy at a 10 plus cap and I can compress that down to a 6.5 or a 7 cap, we know we've got some opportunity to create some real value in some of those assets that are obviously tied to income and, some equity on the back end. So that's what we look for in those particular opportunities. And I would say the last piece is, if right now, a lot of the stuff that we're looking at is, is there seller financing available with the cost of capital right now and compressed, kind of margins due to the capital costs. If there's sellers that are open to doing seller financing right now, that's something that can make deals pencil. And then just having strong, drivable economies around it. Pandemic was a perfect example. Lake Tahoe boomed during the pandemic because people weren't flying to Hawaii. They weren't flying across the pond to go to Europe. They were driving to, the closest destination. So we like to look at, assets that are within strong, striking distance of good quality economies that, still have that demand for leisure travel. And that's definitely something that is always in consideration when looking at different assets around the country.
Yep. Yeah. That's great, Matt. The other thing is, right, as you said, the business travelers, the hotels in the business district, in the center of the city, mainly dependent on these business travelers, they are getting crushed right now because of the, work from home.
Yeah, a lot of different trends now.
Yeah, many trends. People have stopped going to office, even though businesses are forcing them to come to office. It's only like 2 days, 3 days a week you go, something like that. So most of the business now takes place online.
Yeah.
And so for those kind of hotels, right? Well, those they are in distress. Okay. Do you see any opportunity in those kind of buildings or hotels? Like any other, like a hotel conversion or any other means you can make money out of these kind of distressed properties?
Yeah, I mean, when there's oversupply in the market that is not getting absorbed by the demand, I mean, office is another perfect example, right?
Yeah.
When the demand goes away and the assets, existing use is no longer as beneficial as it was once structured, you got to look at different opportunities for a highest and best on a particular asset. So we are seeing a lot of those types of, and most of those are flagged assets. They're not boutique. Most of those are flagged assets, and people are either doing those types of conversions from a hospitality asset over to multifamily or micro living or co-op living.
Mhm.
We're seeing, cities give certain grant money or different variances in zoning to allow easier conversion to provide more affordable housing. So there's definitely some plays in those markets because the infrastructure is there. A lot of these, hotel rooms have a bathroom, have a sink, right? You
Yeah.
can create studios, you can do some mini conversions that, aren't too heavy lift on the infrastructure side of stuff. So I do see some of that stuff happening right now. And I would expect there's going to be continued, conversions in those markets that have an oversupply of, hotel room keys that don't have that type of demand when it comes to business travel anymore, because a lot of those markets were heavily reliant on that. So with, a change in cultural trends, right?
Yeah.
Work from home, the way people are engaging and interacting with brands that they like or that they think are stale or outdated, there's pivots that have to happen. And when
Yeah.
those pivots do happen, I think there's some great opportunity in those types of seasons. And I think we're heading into, those seasons in office and in some commercial real estate assets like hospitality, and even with, apartments. There's a lot of apartment
Yeah.
buildings that, there's an undersupply of hospitality, but an oversupply of multifamily in certain markets. And I'm seeing reverse
Yeah.
conversions from multifamily over to hotels. So I think there is definitely in this next season, especially with the cost of capital, with the Fed and what they've been doing, as well as, what's been going on with a lot of people taking loans that, ultimately are either resetting or, their loan covenants,
Yeah.
they didn't necessarily account for, some of the adjustments and shifts happening the way they have over the course of the last 12 months that, we're going to continue to see more opportunities here over the next
Yeah.
12 to 36 months.
Yeah, absolutely. And regardless of the market situation, whether it's a recession or a bull market, you got to have an eye for an opportunity.
Absolutely.
Yeah. And as you mentioned earlier, right, Matt, you buy down distressed hotels. So when you buy distressed hotels, do you do like a full renovation of the hotels, or what gut renovation, or just minor updates here and there?
It depends on the asset. I mean, distress can be distressed financially because of a situation
Okay.
that the seller's in. It could be the asset itself is physically distressed. It could be the operations team is distressed. There's a lot of different verticals and kind of operating mechanisms, or really, mechanisms that distinguish whether an asset that we believe is distressed or not. But yes, to answer your question, all of the hotels that I bought have been in some form or fashion a distress sale, generally because of the brand that we want to put out on the market. I usually will do a full renovation throughout the assets. We will rebrand them, and then we'll relaunch the asset altogether under the new brand to ensure that it's kind of a clean relaunch, because most of these assets have some form of a trailing stigma or not a good reputation when we buy them. And so making sure that we're kind of cleaning that, that slate, and, putting our brand standards in the asset in terms of the physical condition, the online presence, the operational team. Those are all things that we look at when coming in and relaunching a property.
And do you have an in-house operational team, or you outsource to operational company who are
Nope, we
managing
do all.
hotels for other?
We do
Yeah,
all in-house. Yeah. So that
all in-house.
was kind of the looking back, if I'm grateful for it, but it was probably the hardest and most trying time, especially
Yeah,
through COVID. Obviously the personnel challenges that, came through COVID, obviously the operational challenges that came through COVID. It really kicked our butts. But with that being said, our entire team, fortunately, I've got an amazing team, amazing staff around me. Everybody rolled their sleeves up and put their nose to the grindstone, and we all just got after it and figuring out, one, how do we not only survive during this time, but how do we thrive during this time, and use this as an opportunity to really elevate our operational chops and create more efficiencies in our SOPs and provide more training and support and really become a company that people want to work for. So we do all of our own management in-house of these assets.
okay,
And that has been, a very big challenge, but at the same time, it was one of the greatest opportunities for us to really control the experience over our assets, and not necessarily, as I'm sure you've experienced, using third-party property managers. Nobody's going to care about your property the way you are. And
yeah,
that was my approach, was if we're not going to, outsource this to somebody else, we're going to, oversee these assets in a way that is so obsessive that we know that we're putting our best foot forward. We're leaving, no stone unturned on how we operate and manage these assets. And every time there was a
yeah,
gap where, we fell down, we found a way to, create systems and processes that allowed us to ensure those things never happen again. So self-managing all the assets, while it is an extreme challenge, managing hotels is a beast.
yeah.
It is not for the faint of heart. But that being said, I probably attribute, some of the exits and the values that I've gotten on these properties to the fact that we've self-managed and maintained that self-care over the hotel properties.
Okay. Wow, that's good, man. And can you tell our listeners about any one of the challenge that you faced when you bought your first hotel? Like, what was the major challenge that you faced? How did you overcome that one?
Man, I mean, there were so many on that first hotel. You just don't know what you don't know until you really get in
Yeah.
there. I mean, understanding all the different softwares and technologies and just how the back of house works on a lot of
Hmm.
hotels was very new. I think the biggest challenges in hotels are people. I mean, any
Yeah.
big business that you're going to continue to grow, that's going to be beyond what you yourself can do with your two hands, is how can you become a good leader, a good recruiter, of talent and people that
Yeah.
are aligned with your values, that are aligned with your mission, that are aligned with your vision. And that was challenging. And the biggest challenge on that first one was the fact that it was a smaller hotel under 20 keys. So, for me, my mindset was, well, I'm going to buy this asset and I'm going to put a team in place to run it, and I'm going to be completely, scaled out of it. And on smaller hotels, it makes it more challenging to do that, because the more leverage you put into, the org chart, the more your margins shrink. So it
Yeah.
was finding that balance of how do we capture, the most net operating income and inflate the value of the asset as much as we possibly can, while still building in as much leverage at the same time, and empowering the right people to get them in the right seats with the right tools, training, and resources to go out and succeed in a way that will allow us to capture that NOI and make sure that that value is there. And that was the biggest challenge, of figuring out
Yeah.
what is that sweet spot, and how do you manage people, and how do you attract quality people into your organization when you're a smaller company and you can't necessarily offer as much all the time and some of the benefits as the bigger hotel chains can.
Mhm. And are we actively looking for a new hotel deals right now? How is the market looking for a new hotel? Like, is it based on the current market, right? The interest are rising, the debt service ratio, uh, what do you think? Are you able to underwrite the hotel properties right now?
Yeah, I mean, we're looking at probably 4 or 5 times as many properties to even get close to one that actually makes sense.
Yeah.
Obviously, with the Fed and where interest rates are at, the cost of capital, the tightening of, the capital markets, the loan products that many banks are willing to offer. Obviously, there's SBA, which is a good
Mhm.
option for, different hoteliers that might be looking for hospitality assets, or really any
Mhm.
individual that's looking to purchase, a business, and hotels kind of fall under that as well. There's some good options out there, but again, with interest rates where they're at, it really eats up the margin in some of these deals based on how much leverage you're getting on an opportunity. So I am in contract on a hotel right now out in the Las Vegas market. And fortunately, we've got the seller. This is another distressed situation. The seller is willing to, with our putting down a pretty sizable down payment. But with that being said, the seller's willing to carry that difference for 24 to 36 months at a very favorable interest rate that still makes the numbers pencil on this deal. So sometimes right now it's challenging, but if you can get a seller that's willing to get creative with you, you can find ways of, hey, they get their price, but you got to get creative with us on the terms, and let's figure out how to make this a win-win. And so that's where we're kind of able to look at some opportunities that still make sense, but pretty much all of them have only made sense if the seller is willing to carry paper and do it at some favorable terms, for a short-term time period while interest rates settle down a little bit, while we stabilize these assets, get the value where we want them to be, and then we can recap the deals. But underwriting a lot more deals to even get to a fraction of what actually might even make sense to look, with the second pass.
And how do you funnel these deals? Like what are your main, source of these deals? Broker relationships or direct mailing to the owners? How do you find these deals to underwrite?
Yeah, I mean, we kind of have a couple different verticals in terms of our lead generation. So number one is, broker relationships, bird doggers, wholesalers, different individuals that are constantly I call them my army of brokers. They're the ones that are in the trenches, on the front lines, talking and meeting with sellers, listing properties, pocket listings. So, I'm on a lot of different lists, have built up a lot of relationships with different brokers, around the country in those, asset classes that I'm interested in over the last, 13, 14 years that I've been investing. I think that's a big one that, a lot of people don't always put as much intention and purpose behind. I consider myself a farmer, and I'm always planting seeds every single day with different relationships. And I've got good nurture and follow-up campaigns and how I maintain and water those seeds to eventually turn them into, a crop that is bearing fruit that I can pick. And I'm patient about that. My mindset is crock pot versus microwave. I'm in it for the long haul. I know that it takes time to get the good stuff out of the crock pot versus, putting something in the microwave for 30 seconds and expecting, a 5-course, luxury meal. So
that's what the real estate is, right? It's a long-term play. You can't get overnight rich. You got to wait. And yes, you'll be wealthy at the end of the day. Just wait to watch, nurture. That's it.
Absolutely. So relationships are a key one. Networking is a key one. We do direct mail as well. I think Sonia sent out about 4,000 mailers this week to different RV parks, different hotels. So we've got, consistent mailing campaigns that are going out based on kind of what our needs are in that season. And then, I mean, just like, the first hotel I bought in Lake Tahoe, that was brought to me from somebody on social media. So between my podcast and my different social media platforms and consistently giving people a window into who you are, what are you looking for? What do you, stand for? What are you up to? People are interested. We're in a very voyeuristic society nowadays with social media and this, lens that we engage and interact with humans. And so if you can give people a bridge into your world, I consistently show what I'm doing, where I'm going. I'm trying to teach and share value and, build authority by displaying, what kind of day-to-day actions you've got going on. Over time, you'll, continue to build up awareness and attention and relationships that, again, I get deals brought to me through different social media platforms as well. So those are the main ones: direct mail marketing, the networking and broker relationships, and some of the platforms that are out there that we consistently have campaigns that we're scraping through, or, Crexi, 10X, CoStar, LoopNet, all of your big kind of commercial MLS equivalent databases for commercial real estate like they have for single family. So we've got, consistent campaigns and searches set up there that we're, kind of scraping through. And it's just, it's a numbers game. We make data-driven decisions, and, we track our offers. We track, how many we put out, we track how many we convert, we track, all of our marketing campaigns and the dollars spent. And, those are big things for us in terms of making sure that we're treating and attacking this like a business. Because all it takes is one deal, to completely set you on a different path and trajectory. And so, that's something that I overemphasize all the time is, we're not looking for hundreds of flips anymore. We're looking for one or two really good, juicy commercial opportunities that we know we can buy at a discount, layer in our operating team and model, maximize the income, maximize the physical condition, and ultimately maximize the value of these assets. And when you can do that, the ROI in your time and your skill set, the multiple of that upside is far greater than you can find on anything in single family, and hence why we really have doubled down in that being our core tree trunk and focus of investing in wealth building.
You're absolutely right when you say, the deal needs to be penciled out. Regardless if it is an 8% interest rate or 3%, if, the bottom line is the number needs to make sense. If the 100%. Numbers make sense, you're in. Don't wait for the interest rate to go down,
Yeah. I mean,
you can always refinance later on.
Absolutely. Yeah. I mean, you got to have a good plan though, right? It's you make your money when you buy, but you got to have a good exit strategy for when you're going to sell. And pro formas are so important, right? Many people, they will engineer a pro forma to make it make sense for them, when the reality is, when it comes time to close and the plan behind bringing that pro forma to life, if you don't have a good plan, a good team, and a good execution strategy for how you're going to make what those numbers look like on that spreadsheet real in your P&L and your balance sheet in real life, that's where a lot of people, they get caught. I mean, and that's where we're seeing right now, a lot of people in multifamily, a lot of people who bought commercial real estate, let's say since the pandemic, they modeled their pro forma based on blue sky, perfect scenario. Nothing's going to go wrong. Are you serious? Interest rates won't be 8% in 12 months. No way. Well, all the people who didn't model in interest rates at 8%, and they've got to refi their deal 2 or 3 years later in order to hit returns for their investors or return capital or pay off a note. Now those people are screwed, right? So we really engineer our pro formas. I'm very conservative in my deals because I want to overestimate the areas that most people underestimate. I want to underestimate most areas that people overestimate. And I want to make sure the merit of the deal still stands alone with those conservative assumptions in it. And then the other side of it is making sure that based on what we're seeing there in that pro forma, that my team and I, when we close on that deal, feel very confident that we have a plan that we know we can execute on that will bring those numbers to life. And if you can't do that, when you're taking big risk, and there's a lot more commas and zeros involved in some of those checks that you're writing than when I was writing single family checks, you really start to discern and look at deals a little bit different. And all it takes is one deal to kick your ass and make you realize I'm never going to do that again. And so on the underwriting side of the deal, I don't make emotional decisions. It's, my mentality is real estate deals are like buses. There's always another one coming right around the corner. And you got to know when to walk away from a deal. And, walking away from a deal could be the best decision you ever make, versus a lot of people forcing a deal to happen because they want it so bad. It actually ends up becoming the worst decision they ever made. And when you're trying to take 2 or 3 steps forward by forcing a bad deal, you end up taking 10 backwards, and that can cost a lot of people. And ultimately that's what happens. Most people, they do that on their first deal, and then they get their ass kicked and they never want to touch real estate ever again. And ultimately, right, we all can probably agree that real estate at least is one of the top 3 wealth building vehicles on the planet. And you got to take those learning lessons and turn them into ROI. And that's what my mentality has been. I just keep failing forward and, continue to learn and grow and improve, and just make sure that, the mistakes and the lessons that you learn along the way, they don't become points of risk for you in the future.
So sometimes people get too desperate after they don't, close a deal for a while. They get too desperate. They stretch their numbers too far and try to make the deal, as you said, right? And you're not putting your money, but your investors' money also in jeopardy in that kind of situation. No one is going to trust you, after a few of your deals fails. So that's, you got to be extra cautious when you are using someone else's money. to buy.
Absolutely. I mean, that's the key. You know, I've been fortunate enough to do hundreds of flips using other people's money, and I've never lost their money on a deal.
Yeah.
If I would have lost their money, I probably wouldn't have been able to do as many deals as I would have been able to do. And I have lost money on deals, but it wasn't anybody else's money. I used my own money to ensure that I made all my investors whole and did what I told them I was going to do. Because again, crock pot mentality, this is a long-term game for me.
Yeah.
And so I'm not looking for transactional relationships that I'm going to do one and done. I'm looking to build long-term relationships where I can do multiple deals with people over and over and over again. And when you do right by people and you build a good reputation, now all of a sudden I got people banging on my door saying, hey, you know, can you take more of my money? Or they're saying, hey, can you take my
Yeah.
money? And I also have another guy that's got 500,000
you
or
get,
$100 that wants to invest
yeah.
with you. If I wouldn't have done
Yeah.
right by them, or I would have acted out of, you know, poor integrity or unethically, that's the quickest way to never do a real estate deal ever again. So,
Yeah.
again, focusing on the long-term, you know, value of relationships, being a farmer of relationships, you know, cultivating, nurturing, and doing right by those people. You know, I plan on doing real estate deals. That's the beauty of real estate, right? Is as long as I can hold a pen and sign a check and, you know, get to a notary, I can keep doing deals and building wealth for myself and my family and making a difference in, you know, all the other people that are involved in those deals' lives as well.
Absolutely on spot, man. So Matt, we'll like to wrap up the session because otherwise we can keep going on and
We can
on.
go forever, man.
We can talk for like end till end of the day today. But keeping time in mind, right? We'll just try to wrap up with few final questions.
Sure.
Yeah. So the first thing is, if you can tell our listeners, what is your main source of, I would say, information where you learn and grow from? What are your main sources?
I mean, it all depends on what I'm focused on. You know, I try and minimize my distractions, and I'm more of a consumer of information in very niche channels. So for example, right now, you know, with the distillery company, a spirits company that I'm a partner in, we're heavily focused on relaunching our brand right now. So a lot of what I consume is all around, you know, branding and sales and marketing. Whereas, you know, you would ask me 5 years ago, I was all focused about just learning how to underwrite deals, model pro formas, you know, get into Excel spreadsheets. So I get more obsessed around niche topics and dive into the rabbit holes there and really kind of put blinders on and eliminate all the other areas of focus. But that being said, I'm a big reader of Calculated Risk blog, Unusual Whales. I like to keep a track and pulse on the economy and what's going on with, you know, our economics, with, you know, macro, micro, globally. And that's one of the things that I talk about on my podcast on our Wednesday segment. So, you know, I'm constantly kind of consuming content around that side of things. And then just Instagram with niche kind of grassroots reporters and media companies that aren't, you know, kind of beholden to, you know, corporate interests and are more so just trying to report on, you know, more organic grassroots topics that, you know, oftentimes aren't getting covered in the media. So those are some of the ways that I consume my content.
Okay. All right. And what is the one book that you'll recommend to our listeners, the one that made a significant change in your life or business?
I think for me, and I'll only speak from where I'm at, I recently finished twice 10X is Easier Than 2X by Benjamin Hardy and Dan Sullivan. And it was a great book from the perspective of one mindset, thinking about truly what it means to go 10X in your life and how to have a quantum leap beyond where you're at right now. And the other side of what I loved about that book was they tactically talk about how you can go about doing that. So not just thinking bigger, right, and manifesting it, but what are the tactical and practical ways of actually going and having a 10X quantum leap in your business, in your life? It was a great read. I really enjoyed it.
Okay. And what is the one way you like to give back to the world?
Right now, the one way, I mean, I sit on the board of a couple, you know, charities and nonprofits. I love to be able to contribute time and, you know, money, obviously, in that capacity. But honestly, selfishly, right now, the best way that I can give back to the world is through my kids and, you know, creating great little leaders that are going to go out and, you know, shape the next generation. So right now, you know, I'm in a season of really focusing on my two daughters. focusing on my wife, being a great example, to them of what a good marriage and a healthy relationship looks like, what it means to be a good leader, and how to navigate, obviously, a lot of the challenges that younger kids and generations are navigating today, and specifically what young girls are navigating today. So that's my big focus right now is my two daughters.
I love it, man. How old are they?
They're 9 and 6.
Nice. Still growing up, handful. Once they are teen, the whole, their mind just change, once they're teen. So be prepared for it.
I'm scared. Yeah, I know. I'll probably be hitting you up for some tips here in a couple of years.
All right. So Matt, one final question. How can Decoding Cashflow listeners get in touch with you?
They can always check out my podcast, Millionaire Mindcast, Monday, Wednesday, Friday. I put out episodes. You can always check out millionairemindcast.com, or feel free to reach out to me at official Mattier on any of the social, platforms. I always love, getting messages and responding to people that have heard a podcast of mine, or you can just text my text number, which is 844-447-1555. Reach out, say what up, let me know where you heard me from, and we'd love to connect with anybody that wants to reach out.
All right, Matt, it was nice having you on the show. Thanks for all the information that you provided to our listeners. It was great talking to you today.
Thanks for having me on, Ted.
All right. Thank you, Matt.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.